So the first thing that you do is you hover over the organization that you're interested in creating the forecast for. And although you've been prompted for your default account settings when you first sync the organization, it's worth just double checking that you've selected the appropriate income tax account. So you can check that by going to settings. And then in here, under chart of accounts on the left-hand side, and there's an option up here on the right-hand side called configuration. This lets you update all of your required optional accounts. And if you hover over this info icon, it explains a little bit about why we need these accounts. But you'll see there's also an optional category. In the case of this company, they hadn't yet set up the income tax accounts. And so income tax would have simply been ignored from any forecasts that were being created. So what we need to do to get income tax working is we need to come in here and select first income tax payable account. And also an income tax expense. And it's important to note that it wouldn't work unless you've selected both of those accounts. You can remove these accounts at any time by just clicking the X next to the name. Once you've saved that, then you can head back to the organizations page and you can go to your forecasts. Now, keep in mind that forecasts are a moment in time, so any previous forecast that you created without those default accounts wouldn't have the new default account selections changes take effect, although at some point we will allow you to update forecasts with the new default accounts. So now that we're in the forecast, we can see, okay, we've got a certain amount of income for this organization and operating expenses. So if we have a look under the current liabilities, we'll see that default accounts are represented by a lock. And if you hover over the lock for a couple of seconds, it'll give you a little tip on what that is. So we've got accounts payable, and we've also got GST and superannuation, and you can see here we've got income tax payable. If you hadn't selected those accounts, then you wouldn't have that lock next to it. Now it looks like this company may be making a loss in this month, so actually the income tax payable accrual, it's actually making a loss, so it's seeing a negative amount there. But obviously the idea would be that if the company was making a profit, say of 100,000, it would apply the appropriate income tax rate, which you can find under your forecast settings up in the top left-hand corner. This is obviously set back in that original default account selection screen. This one has an applied rate of 25%. So this would just accrue an amount of 25% on the net profit in each given month. But if you wanted to make an adjustment to that, say that you actually had paid off some of the outstanding tax liability, you can come into your P&L under the assumptions. And by the way, this is a similar concept for superannuation, but obviously we're talking about income tax expense here. You'll see that there's a star against that, meaning that it's linked. And if you hover over it once again, you'll see a little hint to say that this special account, which is directly linked to a corresponding account in the balance sheet, being the income tax payable. So let's say we have a new income line. We'll make this organization just have a lot of profit. Just to better represent what's going on with the income tax payable. So here now you can see, because we're making a huge amount of money, this has now got an applied income tax rate, and so it's got an accruing liability in each month. But in reality, in Australia, where this organisation is based, they would have paid off some of their tax liability at the end of the tax year after they've submitted their taxes. And so you may, obviously it always depends on the situation, but you may put in here, okay, we want to pay off $10 million in our income tax. We'll see that the bank went down a little bit for that month because that was a cash outflow to pay that off. And you'll also once again see under your income tax payable that liability actually declined by a certain amount here. At present, depreciation isn't automated. So what you actually need to do is you need to make two entries. So if we had a current asset, and let's just call this a got an asset which is worth $100,000 on the balance sheet. So what we would need to do is make an accumulated depreciation. So we might say that this has a depreciation rate. Obviously, this is just for example purposes, but let's just say that it depreciates by $1,000 per month. So what we'd need to do is represent that in here. We'd say, it's got an accumulated depreciation amount to it, and then what we're going to do is we're going to say we want this to grow by, say, negative 1,000 to represent the depreciation. That what we're doing here is we're saying, okay, the asset which has got a value of 100,000, and then the first month it's got 1,000 in depreciation, the second month an additional 1,000, and so on and so forth. So that's representing the accumulated depreciation. So obviously here in the month of December, we'd have 88,000 in and 12,000 in accumulated depreciation. But what we'd need to do here is we would need to also make an adjustment in our income statement. Obviously, at some point in the near future, this will be automated for you, but for the moment, this is the workaround to get it to work. So you just need to find your depreciation account, and then you can set all months to, we note that we got depreciation of 1,000, and so now that'll be included in your P&L. Obviously, depreciation is not a cash flow item, so it's excluded from the cash flow. But this is how you would get that entry to be represented in both the balance sheet and the P&L. In Australia, although the rules are relatively similar in New Zealand, so the same concept's going to apply, but this organisation, just to explain, is based in Australia. We have the 4-week standard GST payment on the business activity statements. So the first thing you want to do when you're looking at an organisation and you're want accurate assumptions around the GST, you come up to the forecast settings and you look at the GST payment terms, which by default are immediate. But we'll put those to 28 days, which is standard. And of course, if you go through a registered tax agent, then you get an additional extension of 4 weeks. So you could put that on for 2 months as well. But I'm going to select that here. You can also select your GST accounting basis here in the settings. We're going to leave that as accruals. And now every single item on the income statement, we can come in by clicking on that small cog and look at the configuration and see if these accounts are subject to GST. So this is an income statement, new mock account that we just created. Something might be, we might say like new revenue line is probably a better name for this example. It's subject to GST, and just for your information, do we want to exclude it from the cash flow? No, that'd only be for depreciation and those kind of items. Do we want to include this in the income tax calculation? Yes, because this is going to be income. This is not income tax exempt, and it's not in the superannuation calculation, obviously. So, or in the Kiwi Saver, in the case of New Zealand. So we have now selected this and we're accruing GST. So if we go to the cash flow, we can see under receipts, there's always a GST item. And here we've got a GST component, which obviously is predominantly coming from this massive example. And so the GST will then, you'll see an inflow from the GST receipts. But because we're here in January, you can imagine that if we go back to the settings, this organization is on a monthly GST. And it's on a 28-day payment terms. So actually for this month, there's no GST outflow because there was no income GST component, or very, very marginal in the prior months. But if we look at February, we now have to consider, okay, we made $10 million in January. We're on monthly GST, which means that we're due to pay last month's GST accrual, and here you can see the GST outflow. Obviously, this is a bit of a different example because it's on monthly, but if it was on 2 monthly or 6 monthly, you then wouldn't see any outflows until the next GST installment was made.